Wow, the Fed just cut the Fed funds rate 0.5%. We're going to look at the state of the market here in Central Florida and really look at how this is likely to affect things going throughout this year. And if you're a buyer, homeowner, or maybe someone looking to refinance, what does all this mean? Now, it's also noteworthy that the last time the Fed's only started with a 0.5% cut a couple times, and the last time was in September of 2007, right as the Great Recession was getting started. So that is also noteworthy that that's the last time they started with a 0.5% cut. And we'll look at that data and what that means. Hey everyone, this is Rayce Robinson, your favorite Florida mortgage broker. And let's start with rates, because obviously a couple questions that we all have, or I have being in the market, is one, what's inventory likely to do, right? Too much inventory, prices adjust. Too low of inventory, prices go up. And two, are rates going to go down, right? The Fed is cutting the Fed funds rate. That influences rates, but it's not interest rates. And then how to use this information. So when we look at rates, this was, as of today, the time that I'm recording this, 6.19% is a national average. Remember, everyone's rate's different. And I would say actually, this is more of a unicorn rate. When you see rates, people are typically advertising the best possible scenario. But what I thought was interesting is, it's just 2 seconds ago, we were at 8%. Now we've kind of been hitting this 6.5 for a while, and then now we just busted below that. And the question is how low will we go? But also it's interesting to note that as they cut the Fed funds rate, interest rates went up, and that's because the Fed doesn't really cut interest rates; they cut the Fed funds rate, and the market's looking forward, trying to price in what the Fed is likely to do. And we'll look at that and we'll see where the target is for interest rates and what that is likely to do for both homeowners and potentially home buyers. Now these numbers are September, but they really cover till the end of August. And look at this inventory to 11,500. We'll look at how that breaks down. But last year at this time, we had 6,115. So that's almost a double, almost 100% increase, 88.2 year over year. From last month to this month, still climbing up a little bit, right? 3.2%. Meanwhile, median price still going up, even though inventory's up from this time last year. And it did go down a little bit month over month, but a lot of this has to do with seasonally adjusted prices. Really, median staying fairly flat with small appreciation across the nation. And then we went from 2 months of inventory to 4 months of inventory, and kind of from last month to this month, still really right at that 4 months, just over 4 months of inventory. And then I like to look at distressed home sales. Really 11 distressed home sales, so really no one in financial trouble, and which is a big deal because as far as, comparing it to 2007 and the Great Recession, right now we have this 11,000 homes on the market, 11.5. Back then there was 25 to 30,000 homes, so we are a long way off of there. And then let's just look at the breakdown real quick, and then we'll just go over some of the data. The current rate, they're saying, is 6.09%. Remember, everyone's rate's going to be different based on credit score, down payment, and loan costs. But of this 11,500 homes, 8,000 of these are single-family homes, 2,229 of them are condos, 1,277 are townhomes. New listings, that slowed down some, which makes sense this time of the year. We have sales closed, staying right around this 2,600 which for the last few months. And then days on market, 57 days on market. So still haven't quite hit that 60, which is 2 months. But again, this is really indicative of being in kind of a more balanced market. I like to look at the trend. The trend has been up, more towards in favor of buyers. The question is that likely to continue? And when we look at what Jerome Powell just said about the first rate cuts and what it means for the housing market, they said, we have in fact begun the cutting cycle now, proclaimed Powell on Wednesday when he cut the Fed funds rate. And this is the new target for interest rates. Right now, we are predicted to get down, the market thinks, by end of 2025. This is from Mortgage Bankers Association, Fannie Mae, Wells Fargo, and Moody's, down to about 5.5%. Right now, we're closer, just over 6%. And then as far as mortgage applications, look how low mortgage applications have fallen since really the rates kind of, went up really super fast. If you look at it, we went from almost 3 or 4% to 8% over just like a year and a half period. And then you can see mortgage applications just fell. So we are really at a bottom since they've been tracking it. low for mortgage applications, which explains why housing prices have stabilized, but inventory has went up, right? Because buyers have just chosen to sit it out at an 8% rate. Now, here's the $1,000,000 question. There's no question. We've answered the big question, which is rates are now on their way down. We never had a market correction, even when rates are at 8%. What is likely to happen as rates fall? Well, I can already tell you mortgage applications are picking up. Refinance mortgage applications are picking up over 100%. As rates fall, that's going to drive activity into the market. As payments fall, and people can qualify for more house. I think in that 5 to 6% range for interest rates, to me, is kind of the worst, only because it doesn't free up the people that have 2 to 3% rates to put their houses on the market, right? The Fed has a dual mandate, right? They actually want to tame inflation, right? Keep things affordable by controlling the Fed funds rate. But they also have another mandate to look at unemployment and get stable employment. And when you strip out government jobs, really, because look, the post office is not going to lay out people regardless of what the economy does. When you strip out government jobs and look at the actual numbers, the economy not doing as good when you tie in government jobs because regular companies aren't hiring as much and some are laying off. And so that's why you're seeing the Fed start this cutting cycle, which is going to lower rates, which is going to drive more demand in the market. We shall see if it gets more inventory. But I really think you're going to see this inventory flatten out as more buyers get qualified. So what would I do with this information? That's to me always kind of the $1,000,000 question. First, the assumption we're going to make, barring some black swan event, is rates are going to get lower, market pricing in almost 200 basis points in rates to be lower over the next year. I actually think rates will be lower than 5.5% by the end of the next year. When you look at the natural spread between the 10-year Treasury and the 30-year, that's likely to collapse more than where it's at now. With all that being said, I think rates are going to be at least 5.5% or lower by the end of next year. What happens when rates fall? That drives people into the market. Mortgage applications are already starting to tick up. So if you're a buyer, here's what I would do with this information. Nothing. Do not try to time the real estate market. It never, ever works, ever. So if you qualify and you want to buy a home, it's just probably as good as a sweet spot you're going to get. Rates are lower, demand is starting to pick up. You still have a lot of options to buy a house, right? It's very stressful when every house you go look at within 3 days is under contract. Right now, you can actually get a home that you want, negotiate with the seller, get closing costs paid. People that are waiting for this big price correction, they're always going to be waiting. You know, no one has a crystal ball. Don't get your financial advice from me, but it's not likely to happen. It didn't happen when rates were at 8%. Now we're going down. So we're going to see the market flatten out. Everybody picking some kind of modest appreciation when you look at all the reports. So if you're a buyer and you qualify, I'd buy now. Don't try to time the real estate market. Look, if rates fall a lot lower, you can always refinance, and you're not one of the people trying to compete against a million other people who are trying to buy at the lowest possible payment, right? That's when you want to be refinancing. And if you're a current homeowner and you thought about refinancing, there are lenders offering some pretty low rates specifically on refinancing. So if you're wondering, is now a good time, I'd reach out to me, because you at least should look at it and then come up with a game plan. We're doing this with a lot of people on when is the best time to refinance, and look at kind of, you can time the market a little more on a refinance, right? Because you're not trying to find a home, we're just trying to lower the payment the most amount possible. So hopefully that helps. If you're a home buyer, I'd say get off the sidelines, get in the game. Lots of programs out there to help people get started. If you're a homeowner and you thought about refinancing, reach out to me. I'd be honored to go over some data, go over some numbers, and see if there's a way we can help you now, or at least set up a plan. And as more information becomes available to move the market, as always, I'm going to cover it right here. Have a great day, great week, great month, and I'll talk to you soon.